Welcome back guys to another Zero DTE video, and today Ernie's going to be talking about becoming consistently profitable, so make sure you stay tuned. If you're interested in becoming a pro trader, check out the link in the description where you can find Ernie's education platform. Enjoy guys.
Hey Ernie, I'm still paper trading and I just wanted to know how many trades would I need in my trading log in order for you to audit to tell me as a paper trader that I'm able to trade live now, like confidently? Would it be like 6 months worth of trades, 1 year worth of trades? How long would that be?
That's an interesting question because I'm going to go back to another member, and I don't know if he's online today. So Mr. Dodds, when he first started, he's been with us for a couple of years at least. He's been with more than a couple of years, but he paper traded for minimum 6 months or more
Okay.
before he committed any money. And he did it until he felt like he was confident with his execution and his understanding. And I think it paid off for him.
Awesome. That's literally what I was thinking too, like 6 months to a year, and then I'll just show you my trades. Because this week I'm doing the Sunday retrospective, and this week has actually been very interesting. Out of 9 trades, 7 were losers, 2 of them were wins, and it got my account from 25K up to 25,935. So I profited money off of those two
Yeah.
trades. Those 7 losers were just like nothing. So it's really interesting seeing this because like before I used to trade paper trade, it would be like a little bit of winners and then one big loser. It would be like the exact opposite. But now I'm trading your strategy and I'm seeing the complete flip side. It's like mini losers and then the winners are big enough to account for all the losers and then profit as well. So that's pretty cool to see.
All right. So let me tell you what you should be looking for. You're looking to mimic market returns. And one of the very first things that I relay to almost every single new member in my initial meeting with them is our 3 primary edges. And one of the first things that I talk about is the edge of going with the trend, and then why we go with the trend, and how our asymmetry is all aligned with the daily distribution of returns in the market. So what I'm getting at is that one of the fundamental things that we should have as an expectation, and when we know that we're trading and we're picking trades right, we're mimicking those returns and taking the small trades along with the medium and the big, is that our win rate should be around 50%.
Okay.
If it's around 50%, it's hard not to make money. That would assume also that you're taking the returns in the same kind of distribution that you get with the market. So imagine this, you only trade with the trend. So that means that if you were to study the distribution of daily returns on the S&P, then you would know that 50% of the time it goes up and 50% of the time it goes down, right? You know that. That's indisputable. That's what happens. Even in a bear or a bull market, same exact thing.
Right.
And the reason why we trade with the trend is that when you're going with the trend, the average move with the trend is of greater magnitude than the average move counter trend. That's one of the reasons why we go with it. The other is by trading asymmetrically, we're able to capture those bigger moves if we're going with the trend. Then the other is the distribution of your returns. They're also very similar too. So yeah, let me bring up that chart just to make the point. And the point that I'm trying to make here is that if you're in tune with the market and you're applying the strategy correctly and you're truly a probabilistic trader and you're taking the small and the medium and the big wins, then you should start mimicking something similar to the returns, and the asymmetry in your strategy should start realizing some significant profit, or better, a market return. This is a distribution of returns on the S&P. Now there's some really interesting things here, and if you were to like analyze my returns over a long period of time, you would find certain things that mimic it. One is the percent of what we consider the 1 standard deviation move. There's a reason why when we put on a trade, why we put it on where it is, because we're expecting a certain number of the trades to go so far towards. Thought about this a long time. Why does 1 to 9 and 1 to 10 and 1 to 12, why does it work so well, right? And the reason is that distribution of returns. So here's the distribution of returns since the year 2000. And like I said, 50% of the time you go up, 50% of the time you go down. If you were to look at where 1% is, it's right about here. Let's see, this is 1% from here, negative, and this is 1% positive. right? So these are all 1% moves or under. And you can see that the smallest moves are pretty small, right? The frequency of those moves. So most of the moves that we get in the market are all within here. Then there's a number of medium size and big moves. So what that's telling you is that in your strategy, when you're entering the market, say right there, let's see if I can use another color to enhance that. So you're going to enter the market right here, and your strategy is out here. That 1% of moves typically is somewhere around here, somewhere in this area, right around there. It might be a little bit more, right? So what that is saying, that's about 75% of all the moves that happen in the market are that 1% move, either plus or minus. But if it's in our direction, it's 37.5%. What I'm trying to tell you is what your expectation should be. All right. And what I found is that if you start being diligent about taking the small wins and not letting them slip through your hands, in fact, if you just took just small wins and took them frequently enough, you will offset all the losses. Now, the losses, 50% of the time, it's going this way. 37.5% of the time, it's going to be these small wins, which are going to be anywhere from about a 25% return on your risk to about a 200% return. So in other words, if you took $100 risk, then you're going to, on average, return between $25 and $200. The remainder is 12.5%. Now, what I found over time is that my frequency of hitting the pin trade, which would be the pinnacle, is about that 2.5%. All right. So those are trades anywhere from about 400 to 1,000% return. I don't know if I've had some trades over 1,000, but I would say that that's probably a good target, but it's somewhere between 400 and 900, 400 and 1,000, something like that. The remainder 10% are between this 200 and 400. So that's approximately the rate of returns that you should be seeing. And it's about the same frequency of these returns. That 1% is about that 37.5%. These medium returns is that 10%. These outliers is that 2.5%. Now, obviously, the vast majority of our returns are that 37.5%, those moves under 1%. If you're not taking those wins, it's going to be very difficult to create a positive overall result. You may have some of those big wins like you experience. You have a very low win rate, and that means that for some reason you weren't able to capture those small wins for whatever reason, indecision or whatever. I don't know.
Yeah.
But you did get a couple of those 10%ers or 2.5%ers, those medium to large wins.
Yeah.
And they kept you in the game.
Yeah, that makes sense. Wow. Okay. Yeah, because the lowest loser was like $43. The highest loser was 158, but my highest winner was 1,339, and my medium winner was 156. So like offset everything. Yeah, exactly what you're making here.
Yeah, I discovered this after thousands of trades, and and it started to become consistent. The other thing that I noticed, so there are certain attributes that you're looking to do, certain goals, I guess. The most basic one is being a 50% winner. And that's why it is so important not to try to guess the market, just go with the trend. If you go with the trend, you are going to trade 50%, assuming you're taking the winning trades and not letting them slip through your hands. When you let even a small win slip through your hands, it wildly skews your results.
Oh, wow. Okay.
Just think of the turnaround. You're up $100, right? And it was a $200 debit. And you let it slip through your hands. It's only a 50% winner, but you let it slip through your hands. That's a $300 turnaround.
Right.
Wow. It's massive. And if you're letting that happen too often, it doesn't take too many of those to totally screw your P&L.
Right.
That's why it's so important to take the small trades.
That's a good point.
And not sit there trying to always hold out for the big ones. When you start taking the small trades and you start developing a positive P&L, it's going to be easier for you to hold out for the big ones. And you're going to have more confidence and be under less duress to hold out for those big ones. But holding out for them in a scared mode is going to kill you. That's the difference.
Awesome. Thank you for explaining that. That makes a lot more sense now why my results are the way they are.
Thanks for watching, guys. I hope you enjoyed the video, and if you did, make sure you hit that subscribe button and hit the like button below. If there's any questions that you might have for Coach Ernie, make sure you leave them in the comment section. Thanks, guys.